Welcome to the Explainer. So you've probably heard all the buzz about small cap stocks, right? How they're completely on fire. But what if I told you there's a really weird twist to the story that almost nobody is talking about? I mean, you've definitely seen the headlines. You've heard the buzz from experts, probably from your friends too. And let's be super clear here, this isn't just hype. The returns we've seen in small cap investing lately, they have been absolutely extraordinary. We're talking about some truly mind-boggling numbers. Look at this. Some funds have pulled in returns of 60% in a single year. So of course, that kind of performance has kicked off this massive gold rush. Everyone's pouring their money and trying to ride that same wave. Okay, but here's where things get strange. This is the real puzzle. If small caps are such a gold mine, why are some of the biggest, most successful funds out there suddenly slamming their doors shut? They are literally turning away billions of dollars in new money. It doesn't make any sense, right? All right, so here's how we're going to break this down. We'll start with the gold rush, then get into the big problem of too much money chasing too few stocks. After that, we'll look at the two paths you can take, the managed fund or the DIY route. And finally, we'll figure out how you can choose the right strategy for you. Okay, first up, the small cap gold rush. Before we dig into the problems, let's just take a second to understand what all the excitement is about. Why is everyone so hyped up? All right, now for the main event. Too much money, too few stocks. Now that we get the hype, let's really unpack the core risk here. This is the real reason those big funds are basically putting up a "sorry, we're closed" sign. So to get what's going on, we first need to know what we're talking about. What even is a small cap company? Well, in India, it's pretty simple. You take all the publicly listed companies, and if it's ranked 251st or lower by size, it's a small cap. Basically, think of the 250 biggest, most well-known companies. Everything else? That's the small cap universe. Okay, now get this. Look at the sheer scale of the money that's chasing these little companies. A single large small cap mutual fund can be sitting on something like 50,000 crore rupees. That is just a tsunami of cash from millions of investors like you and me. And that huge fund? It's trying to invest in companies that are, well, tiny by comparison. We're talking about companies that might be worth less than 200 crore rupees in total. And this right here, this visualizes the problem perfectly. It's that classic tsunami of cash trying to fit into a small bucket problem. You've got this 50,000 crore fund on one side and this tiny 190 crore company on the other. It's a fundamental mismatch, and that is the core issue we're dealing with. So what does that actually mean? Well, here's the critical point. This flood of money can inflate a stock's price way beyond what the company is actually worth. It's not going up because the business is doing better. It's just too much money chasing too few shares. And that creates a bubble. Responsible fund managers know this, and they know that bubbles, well, they always pop. That's the risk they're trying to protect you from. Okay, so with that massive risk in mind, what are your options? Let's talk about path number one, the mutual fund, or what I like to call the managed path. This is where you let a professional handle all this complexity for you. And you know what? The data really backs this up. If you look at the 5-year average returns, managed small cap funds have, on average, done better than just buying the whole small cap index directly. We're talking almost 18%. That difference suggests that the pros, on average, have actually been earning their fees. So the appeal here is pretty clear, right? You get a professional fund manager doing all the hard work. You get diversification across a whole bunch of different stocks. The risk is managed mathematically. And as we just saw, there's a history of higher average returns than just buying the index. But hey, what if you're more of a hands-on person? This brings us to path number two, the direct investor or the DIY path. This is for those who want to be in the driver's seat. Now, if you are gonna go down this road, there are a few common strategies. One is to track the big bulls. Basically, follow the portfolios of super successful small cap investors. Another is to dig into company filings, looking for those hidden insights. Or you can use stock screeners to hunt for companies that fit your specific criteria. So for example, if you were tracking an expert investor like Ashish Kacholia, your watch list might suddenly include names like these. Yeah, probably not companies you've heard of at your dinner table, right? This is deep dive stuff. Which of course brings up the million-dollar question, but is it really that simple? Can you just piggyback on their trades and call it a day? And the answer is a hard no. The experts will tell you that just copying trades is a terrible idea. The real homework, the stuff you have to do, is intense. We're talking about investigating the company's website to see if it's even real, checking if there's enough liquidity so you can actually sell when you want to. You have to analyze the financials, study who owns the company, maybe even try the product yourself to really get it. So that brings us to the big decision. We've got these two very different paths laid out. How on earth do you choose your strategy? Well, it really boils down to this: effort versus reward. And this table really sums it up nicely. Look at path 1, the mutual fund. The effort required is low, but the risk, while managed, is still high. You need basic knowledge, and the potential outcome is market-beating returns. Now look at path 2, direct investing. The effort, very high. The risk, extremely high, because your money is concentrated. You need expert-level knowledge, and the outcome, well, it could be extreme gains or total loss. You know, at the end of the day, it doesn't matter which path you're even thinking about. The timeless wisdom of investing always comes back to this one idea. The holy grail isn't just finding a quality company. It's finding a quality company plus a margin of safety. You need to buy it at a price that protects you if you're wrong. And that leaves us with the final question. Look, it's not about which path is the best one. It's about which path is the best one for you. Which one lines up with how much work you're willing to put in, what you actually know, and how much risk you can stomach. That is the real small cap puzzle you need to solve for yourself.